UMAC breaking news, details how Unusual Machines, Inc. hit its first profitable quarter and at the same time secured $72 million for a huge expansion into NDAA-compliant drone parts.
It really is the definition of an inflection point. The material makes a strong case that UMAC is shifting from this, speculative R&D company into a real financially solid Tier 1 supplier for the U.S. drone industry.
They're showing a 39% year-over-year revenue bump for the quarter, and that $72 million in capital, that sets them up to build out that domestic capacity.
Absolutely. But our job is to look past those headlines.
We have to. We need to really scrutinize the quality, the robustness of these foundational numbers.
For sure. That $6.3 million year-to-date revenue, that shows real market traction, which is fantastic. But if this story is going to land with, serious long-term investors, we have to make sure the excitement over the net income number doesn't just gloss over the operational reality.
Let's start right there, with the financials. Our first critique is really about clarifying where that headline profitability actually comes from.
Right. To maximize credibility, the material has to clearly and strategically separate the operational growth success from the reliance on these non-core financial gains that they use to hit that big number.
And the weakness right now is that the material really leans into the $1.6 million net income as this historic profitability milestone.
The number that validates their financial stewardship. It's an attention grabber.
Of course. But you dig in just a little, and you see that the profitability was, and I'm quoting, significantly boosted by $5.8 million in unrealized gains from short-term investments.
And there it is. That's the trust hurdle. For anyone not staring at financial statements all day, those are unrealized gains.
Meaning paper gains.
Paper gains. They haven't necessarily been turned into cash, and they definitely didn't come from selling drone components.
And if my math is right, if you back out that $5.8 million, the actual operational performance was a loss of over $4 million for the quarter.
That's the nuance that gets completely lost. Investors want to see that the core business, making and selling parts, is on a path to paying for itself.
So focusing on the $1.6 million almost feels like they're hiding an operational loss behind some smart treasury moves.
It can come across that way.
Okay, so the weakness is putting too much weight on a non-recurring gain. How do they fix this without sounding, defensive?
The suggestion is to shift the focus of the profitability milestone completely away from that $1.6 million. It's just not repeatable.
It's subject to market swings.
Totally. Instead, you lead with the sustained, accelerating operational revenue growth. That 39% year-over-year growth, the $6.3 million YTD, that should be the hero metric. That shows operational success.
That's a powerful shift. It changes the story from, we made money this quarter on our investments, to
our core business is accelerating like crazy. And, by the way, we're also managing our cash so well it's generating extra runway for us.
Right. So the $5.8 million gain gets reframed as proof of disciplined capital management, not the driver of profitability.
Exactly.
So for a concrete example, instead of leading the press release with the $1.6 million, the headline should lead with the YTD revenue of $6.3 million.
Highlighting the 55% year-over-year growth, that is undeniable market traction. You can't argue with that.
And to really nail that new framing, you could even restructure that profitability section to say the company almost hit operational break-even.
Yes, that shows strong unit economics, that the fundamental business is healthy, and it was then reinforced by the investment income.
That framing really does speak to fundamental strength. And for the earnings surprise, the focus needs to be on how their operational strength helped them defy the loss forecast, not just on the $1.6 million result.
That distinction is everything for integrity. Okay, so that handles the internal financials, but let's shift gears to the market perception, specifically the fallout from that huge capital raise.
Which brings us right to our second point on audience alignment. The very bullish narrative here has to acknowledge and logically bridge this pretty massive disconnect between the price they raised money at and where the stock is trading now.
This is probably the trickiest data point in the whole document.
I think so too.
They proudly state $72 million was raised through an ATM offering at an average price of around $15.46.
And the current price is noted as $7.88.
That's a 50% drop, a 50% haircut since they got the cash in the door.
And the weakness is just calling this a pullback without any real context. Every investor is asking, why didn't that $72 million plus the Rotor Lab acquisition and all this good news stop the bleeding?
Ignoring it makes the narrative feel incomplete. Or worse, like they're being evasive.
So you can't just skirt around the dilution issue. The market knows what an ATM offering does.
Exactly. It floods the market with shares. So the suggestion here is to get in front of it. Introduce a brief, direct analysis that frames the price decline as a necessary short-term market reaction to that dilution.
And then immediately link it back to the long-term value created by that dilution.
You have to. You control the perception by owning it and explaining the strategic necessity behind it. You inject confidence.
Okay, so concrete examples. Maybe insert a clarifying statement in that section on market reaction. Explicitly say, the post-ATM dilution has stabilized.
Yes, and then you pivot. You pivot hard to asserting that the current valuation at $7.88 offers a really attractive entry point relative to the analyst target price of over $20.
Right, you cite the 163% upside. You shift the focus from fear to opportunity.
That juxtaposition is so important. It shows management sees the current price, but they're not fazed because they're focused on the fundamental value.
We could also suggest a rhetorical device, something that flips the dilution from a weakness into a strength.
How so?
Emphasize that management prioritized securing a fully funded $80 million cash runway to execute this high-stakes NDAA strategy.
So they viewed the temporary price pressure as a calculated trade-off.
A necessary trade-off for speed and certainty. That kind of conviction is what institutional buyers want to see.
And you have to mention that the 1546 ATM price isn't just some historical number, it's relevant. It's the high water mark of institutional confidence before the market adjusted to the new share count. It anchors the conviction level.
Agreed. Okay, so from the hard numbers and market perception, let's move to the core strategy itself, the expansion. This is where execution risk comes into play.
Which is our third critical point. We need to bolster the strategic narrative against that execution risk.
The way it's laid out now, the entire expansion thesis is really heavily anchored to securing defense contracts. They reference the Pentagon's Replicator initiative.
And they explicitly state that the first major defense contracts are the next big catalyst.
The weakness there is just, it's a singular dependence on government procurement. And we all know how the defense sector moves.
Incredibly slowly. Government contract cycles are, notoriously unpredictable. They're subject to budget delays. They can take years.
So if the whole growth story hinges on a government signature, a lot of investors are just going to sit on the sidelines and wait. And that wait could be a long one.
That is the exact execution risk that has to be mitigated proactively. So the suggestion is to broaden the immediate application strategy. UMAC has to show that these new high-performance, U.S.-made components,
like the motors from Rotor Lab?
Precisely. That they have immediate, high-margin, commercial and enterprise applications that can act as a revenue bridge while they wait for those big defense contracts to roll in.
It's about de-risking the near term, proving the new assets have utility today.
That's it. For concrete examples, the material needs to elaborate on the Rotor Lab tech, those high-performance motors. How do they create an advantage in the commercial drone space?
Right. Things like heavy lift logistics or infrastructure inspection, agriculture, sectors that need high-quality domestic parts now.
Exactly. Right now, the material is focused almost entirely on the military use for the new Orlando facility. And that's just too narrow.
So we need to suggest they show the initial utilization plan for that Orlando capacity beyond just defense needs. Highlight immediate sales channels in other enterprise markets that also need made-in-USA parts.
That diversifies the revenue stream away from that single defense catalyst.
And, a final way to expand the angle here would be to reframe the Orlando facility's strategic reach.
It's not just for the Pentagon.
No, it's a manufacturing hub that can capture global market share. So many allied nations are looking for high-quality, non-Chinese components. That blows the addressable market wide open, beyond just a U.S.-only focus.
That holistic approach, commercial bridge, domestic enterprise, global sourcing, it makes the entire expansion look so much more resilient and, frankly, more immediately valuable.
This has been a really targeted critique. I think the goal here is to maximize the credibility of what is, at its core, incredibly positive news. Let's just quickly summarize the actionable steps.
Okay, so we focused on 3 key opportunities. First, recenter the narrative around operational revenue growth. Get the spotlight off the one-off unrealized financial gains. Operational strength has to lead.
Second, you have to directly address the price volatility from the capital raise, the 1546 versus the 788. Frame the dilution as a necessary strategic trade-off for that $80 million runway. It maintains trust.
And third, broaden the expansion story. You have to inject those high-margin commercial and enterprise applications as revenue bridges. Don't let the whole thing hinge on the unpredictable timing of a defense contract. De-risk the execution.
I think these adjustments will transform what's already a strong announcement into a really robust and logically complete narrative. It'll help UMAC realize that upside potential analysts are predicting, that average target of $20.74. We encourage you to implement these changes and submit the material back in for a follow-up.
We'd love to see the final strengthened version. We look forward to seeing your progress.